I was sort of mildly bullish all of last year. I became less bullish in late December, simply because I just didn't think that when you see the market cap to GDP was 210%. When you have that expensive of a market, pricing in, at that time, it was like 15% earnings growth. I just didn't see, based on idea that Trump would be able to extend the tax cuts of 2018, but not add to them. And then when you add to that tariffs and other liquidity metrics that I look at, I just didn't see it was possible to get 15% earnings in 2025. So I wasn't out. I still am not negative on the market. I am not short the market. What I said was the upside is very limited. It's not better than the opportunity just to own bonds. So I took a lot of de-risk the portfolio, and owning bonds has been a great ballast to the few longs that I have, along with gold, has managed to actually make us a positive return in Q1. Whereas if you look at things like since mid-February, you see the NASDAQ down almost 20%, the S&P down over 10. So it's been a rough start to the year. So I guess so far I've been right. Now, I'm not going to sit here and say that I absolutely knew the market was going to crash by 15%. I just said that the risk-reward ratio based on negative equity risk premiums favored bonds. When you combine it all in the mixer here, you've got tariffs, you have a greatly reduced labor force. This is wonderful for long-term prosperity of the United States to know who the heck's coming in our country. But when you shut off the borders, there's just less people working. And that's putting downward pressure on GDP growth. But more importantly than all that, went into my thinking that we're not going to get 15% earnings growth in 2025. That hockey stick that Wall Street always projects is just not going to happen. But if you look at liquidity measures like what's going on with the Treasury general account being drained, the reverse repo facility being drained, the level of the real Fed funds rate being positive for 2 years after being negative for most of the last 15 years, profoundly negative at times, bank lending standards tightening, the liquidity metrics are just not there anymore. We've exhausted most of the pandemic stimulus that was $6 trillion that was piled into banks in excess reserves and was sloshing around the economy and found itself parked in the reverse repo facility. We have some liquidity issues that we're dealing with in conjunction with a rapidly deteriorating economy. And one of the salient problems is I don't think that the Federal Reserve can really come to the rescue. Let's just look at what happened. We had the ISM March manufacturing data that came out, which clearly shows that the economy is faltering. If you look at the subcomponents of employment and new orders, the actual headline number was falling further into contraction, but the prices paid component surged. It's like 69.4 or something like that from 64. So the Fed has a real problem here in that it can't aggressively and proactively reduce interest rates, given the fact that inflation has been well above its target for 4 years and is rising further away from its target. I mean, how aggressive do you want to get in that scenario? And even if they had the temerity to aggressively cut rates now, what would the long end of the bond market's response be? I think it could be very negative and interest rates could spike. Look, if you put Powell into a corner and said, do you care most about inflation rising out of control or a recession/depression? And he would always say, listen, I care most about the economy. I will say I'm going to hold my nose, cut rates. I care much less about inflation because I could always obfuscate around it. I could change the metrics. I could say, well, we're no longer looking at inflation. We're not looking at CPI headline. We're looking at core. Oh no, we're looking at core PCE. Oh no, we're looking at super core. I mean, they could just dance and substitute and dance their way around that. They care most about people being out of work because you can't really lie about that. People know when they don't have a job. That's a fact. They're going to cut rates, but they're going to be doing it in arrears. They're going to be doing it ex post. They're going to be doing it after the fact. That's what they always do. So did the Fed cut rates in July of 2007? Yeah, they did. Did they continue to cut rates all the way to zero by the end of 2008? Yeah, they did. Did that stop the housing market from crumbling 33% or stocks from faltering 50%? No, it didn't. The Fed cut rates in 2001. Did that stop the NASDAQ from going down 80%? No. And did it stop S&P 500 from falling 50%? No, it didn't. So I don't understand this idea. Well, the Fed's just going to cut interest rates and everything's going to be great. Where's the history behind that? And it's even worse now because they have inflation as a big problem that they're 4 years above their asinine 2% target, as I'm fond of saying. So they can't proactively cut interest rates. They're going to act ex post. They're going to wait for the unemployment rate to spike. They're going to reluctantly and with reticence start cutting rates. It's going to be too little, too late, as it always is. And the market is going to have a 30, 40, 50% correction. That's my projection. what I am waiting for in my model, I don't have tariffs in my model. What I have is financial conditions and credit spreads and the copper gold ratio and the level of the real Fed funds rate and liquidity metrics. So those are all things in my 20-point model, which is looking at the second derivative of inflation in the context of economic growth. And we are getting very close to that point where I am going to become neutral and then possibly even net short in the portfolio. Don't forget, you don't have to be net short to make money. Shorting the market is very difficult, and you shouldn't short the market and go to sleep. That's for sure. That's not going to work. But if you have a very little equity exposure and you have the right bonds in your portfolio, you can still make money in a chaotic disaster in the economy. There's going to be some tariffs. Tariffs are taxes. Some of it will be on the margins of U.S. importers. U.S. corporations may reduce their margin. Now, how do you get any earnings growth at all when the U.S. economy is shrinking? If you look at the Atlanta Fed's latest projection, it's minus 2.8. So if the economy is shrinking in real terms, and in nominal terms, it's barely growing at all, and margins are compressing, you tell me how we can get 11% earnings growth. It just can't happen. So the risk-reward ratio is to own short-term treasuries. I've sprinkled a little bit of duration in there, but it's not that long. It's just a little bit off of 2 years. I wouldn't go hog wild as of right now in duration in the coupons. That window is going to be very short-lived, in my opinion, because on the other end of this recession, depression, freezing of the repo market and the credit markets, you're going to see the Fed go to zero, go back to QE. Maybe there's another form of helicopter money. Deficits are going to jump to 5-6 trillion per annum. And there's going to be more debt monetization ever before. The Fed's balance sheet is going to skyrocket into the double digits from 6.7 back to 9, maybe to $12 trillion. And inflation is going to be going back to double digits again. In that scenario, do you really want to be long a 20-year? Gold is sniffing out the falling real interest rates. If I told you that the Fed has missed their inflation target for the past 4 years and they project they won't get back to it until 2027, if I said they were going to be missing their target for 6 years, would you guess they'd be in a cutting cycle or a hiking cycle? Here's the funny part. Here's another punchline. The Fed says everything we do is in the service of the American people. Well, I came across a stat today that for the first time in history, the top 1% of earners have more wealth than the entire American middle class. So the quintiles between, if you're above 20% but below 80%, you're in the American middle class, you have less worth than the top 1% of earners. Now, does that happen in a fully free-functioning capitalist system? No, it does not. Mr. Powell, you're not in the service of the American people. You're not even in the service of keeping inflation at 2%. You are in the service of making sure bank assets never go down in value, so banks don't go insolvent and bankrupt. And by doing that, you create tremendous amount of reserves, which are used to buy bonds, which makes the Treasury solvent as well, keeps interest rates low. Your balance sheet used to be just a few $100 billion not too long ago, Mr. Powell. Now it's gone to over 9 trillion. You've reduced it to 6.7, but you go, oh, that's enough. We're going to stay around $6.7 trillion. And then we're going to go much higher from here. What's on that balance sheet? As you know, it's mostly treasuries. So if the Fed is an ignorant, automatic buyer of treasuries, guess what happens, right? The price goes higher and the yields go lower. That helps the Treasury finance wars and profligate spending. It also manages to buy mortgage-backed securities and make sure that the American people who they are in service to can't afford a house any longer. It's funny because it's so ridiculous. But what I just said to you is sad and true. I don't think there's anybody who can debate that honestly and be intellectually honest and say, wait a second, the middle class of America is doing great. No, they're not. Oh, well, people can afford houses. No, home affordability is the lowest it's ever been. Well, how did that happen? Was it because lumber prices went too high? No, it's because you put trillions of dollars in mortgage-backed securities. You were buying mortgage-backed securities, Mr. Powell, in the spring of 2022, years after the pandemic broke out. So they're in the business of wiping out the American middle class, and they've done a great job at it. If we do enter a bona fide liquidity crisis, people sell what they can to get cash, and gold is one of those things. It will be a short-lived correction if that happens. It happened in 2008. I don't see why it wouldn't happen again. But then after that, for the next few years, gold just skyrocketed. The main function behind the purchase of gold is falling real interest rates, but there's other things going on too. It's first of all, the idea that cryptocurrencies are a ballast to equities or they're digital gold is complete BS. I mean, Bitcoin has lost more in value than stocks while gold is rising because gold is money and Bitcoin or any cryptocurrency is not money because blockchains, although very useful, are not unlimited and not rare in nature. AU is rare in nature and virtually indestructible. That's why it's money. It's a store of value. So Bitcoin is a reflection of the liquidity in the market. So when stocks do well, Bitcoin can tend to do well. And when stocks do poorly, Bitcoin will do poorly. But gold will also do poorly in a liquidity crisis. But I can assure you in a liquidity crisis, Bitcoin will crater